Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, 4th of February, 2025, recording this in the morning. Okay, so let's just have a quick look and sort of see a little bit some of the fallout from what happened yesterday. Obviously, as everyone probably knows, there was some short-term reprieve for Canada and Mexico, and basically Trudeau of Canada and the Mexican president essentially gained themselves a 1 month reprieve by promising to beef up security at the borders on immigration and to the drug import and fentanyl and all that kind of stuff. I don't know how much of a victory this was for Trump. He's certainly going to claim it was a victory. I mean, for example, in the case of Canada, there was the talk of 10,000 men and women now guarding the borders. But actually, there already were 8,500 Border Patrol agents. So, a little bit of an increase there. But anyway, Trump likes to have big figures, and he can claim that as a short-term victory. But I think what we have to take away from that is that this is just on the so-called drug war and immigration, and it's not really about trade. And trade agreements are normally a lot more difficult, and we'll see that that's going to take a lot more time, and will be more difficult with China and the European Union, and potentially even some of those trading partners. I think the other thing to take away is that how a market's going to react going forward. And it seems to me that there's some talk that Trump maybe, in the case of Canada and Mexico, that there was a domestic backlash, a domestic sort of reaction, putting pressure on Trump to make a deal or not be that strong, because there would be immediate pain for U.S. Consumers. And that's going to be a little bit more, a bit more less obvious in the case of, let's say, Europe and China. So we'll see going forward. The other thing, as I said, is the market reaction. And I think the way the market's going to react now is going to be two things. So number one is that we possibly have the knowledge now, or at least the thought, or at least the theory that Trump will, he basically wants transactional victories. He wants to be able to put quick pressure on people or countries, and then to have a quick victory, which he can then sort of, post on his social media and say, you see, this is what I did. And so I think the market knows that now. And I think rather than assuming that he is going to be very serious and will, potentially take pain, I think the idea now is that he will try and, get a quick compromise for a quick victory. So what that means in things like sort of FX and actually all of the asset markets, I think, is maybe when there's an announcement or the threat of a tariff, yes, there'll probably be a reaction, but I think it's going to be a diminishing, ever more diminishing kind of reaction. And the market now will place much more attention, not so much on the threat, but will actually wait for the implementation and the reality, the concrete reality of that. So I think the reaction function is going to be a little less volatile. On the other hand, let's just keep in mind that in the case of Mexico and Canada, there's only a 1 month delay. So there's always the threat of tariffs being implemented. In the case of China, they went into effect last night at 12 o'clock at midnight. The 10% tariffs. China has retaliated with a 10 to 15% tariffs on a lot of energy products, including nat gas and also farm equipment. And then, of course, we've got Europe. So I think the point is that it's going to be difficult. We probably are going to be in a little bit of a holding pattern, range trading, kind of choppy kind of environment, because it's not as though the all clear has been sounded and there will not be any tariffs. On the other hand, we don't necessarily take the threats of tariffs with 100% seriousness. So I think there's going to be, as I said, sort of a range trading choppiness. And you can see that in something, let's say, like the equities. So for sure, we got a little bit of a bounce yesterday on the equities, on the news of the so-called compromise deal with Mexico and Canada. But what you guys can see here, this is on the daily chart for the ES futures. You can see that, they basically just bounced up a little bit, but already, in the last few hours, is sort of giving that back a little bit and finding it hard to really push a lot higher. And as you can see, we've essentially been trading in a range since mid-December. So the market is finding it a little tougher to go up. And I think that's also going to be the case for the US dollar. We can see if we go on the Dixie, on the dollar index, which is here. Obviously, it had been very strong on the threat of tariffs, and then it's coming back down. But the point now is like, can the dollar index actually really fall? I mean, will the dollar index go down to 105, 104, 103? I'm not sure that that's going to be possible. I mean, for sure it could come off a little bit, but the reality is that there is still the threat overhanging of tariffs, and the reality is that the US economy does seem to be outperforming Europe and China, for example. So I think here, probably we're going to be, any tariff headlines, we might pop 50 or 100 ticks, and then maybe on any sort of relief rally, it might go down 50, 100 ticks. So my best guess would that be for the dollar index, we might be something like 107 up to 109, something like that, a fairly tight range, because we really need to understand, what is going to happen with the more serious tariffs. For example, what's going to happen with China going forward, and of course Europe, and we see this sort of reaction function. Let's look at something like. The AUD CAD, which is kind of an interesting one, because if we look at AUD CAD as a reaction, I mean, ordinarily one would have thought that this would be sort of a huge amount lower. Now it has gone lower, as we can see in the last day or so, 50, 75 basis points. But if you actually look about that, Australia, there has been sort of tariffs actually imposed on China, which of course is Australia's greatest trading partner. But the point here is that this should have been extremely negative for Australia, because Canada, in a sense, has been, saved or reprieved from tariffs, whereas Australia's main trading partner, China, has actually had 10% tariffs put on it and maybe more to come. So ordinarily, we may have expected like 1% or 1.5% move. Now, it has gone down, but it hasn't absolutely collapsed. And so I just wonder if this is, still this idea of not fully taking Trump sort of at his word to be serious about maintaining the tariffs, for example, in this case on China. We shall see. But that's an interesting one to keep a lookout for. Having said that, we can't forget the fact that, especially for the high beta FX kind of currencies like Australia, New Zealand, Canada, Korean won, some of these trade currencies, the threat of tariffs and disruption to global supply chains and global trade networks is definitely a problem, and will create uncertainty and nervousness, as simple as that. And anytime you have uncertainty and nervousness with those high beta FX currencies, they generally don't do super well. Excuse me. I think I have a little cold here. I'm going to have a sip of tea. English breakfast this morning. Okay, so let's look at a couple of different currency pairs as well. I want to look at the euro, for example. That's an interesting one, because so far there haven't been any tariffs announced on Europe. Trump, for sure, is threatening it. As you guys can see here, Euro USD, we had a big trade range, this kind of lilac purple box for going back quite a long time. Euro broke down, tried to get back into the box. It failed there and is now sort of breaking down, but has now bounced a little bit. We had a little bit of a rally. You see this little bit of a rally here against the US dollar, basically on the sort of trade reprieve with Canada and Mexico. And so the logic here is that, maybe Europe will escape it. And that's possible. That's possible. There's some optimism there. But keep in mind, as I was saying earlier in the video today, that Trump was under a lot of pressure from a lot of constituents and kind of lobby groups immediately in the US, like the oil refiners and car companies and everything like that, to maybe sort of scale back the tariffs on Canada and Mexico. He won't necessarily have those pressures on him in terms of Europe. The other thing as well is that he could claim a quick victory on the drug war and immigration on the borders with Mexico and Canada. That's not the case in Europe, because the reality is there are not a huge amount of illegal immigrants coming into the US from Europe, and the drug situation seems to be less dramatic. So the point is that when we talk about Europe, it's much more a question of trade, not so much like drug imports and illegal immigration. It's really a trade thing. And we know that's going to be a lot more protracted, contracted, difficult. That's going to be a much tougher kind of negotiation. Trump will probably talk about NATO, probably threaten to withdraw from NATO. I saw yesterday from the Polish foreign minister an article, I think it was on Bloomberg, basically saying that Poland is spending more on defense and getting up towards Trump's target of 3 or 4% GDP on defense. So it's got to be a lot of sort of toing and froing there, and I think this is going to be a lot more difficult. So I think the point is that yes, we did see a relief rally on the euro, but there's still going to be pressure on Europe. And the other thing as well is that Europe is a major trading partner, as we all know, with China and more so to the US. So there is sort of those imbalances and deficit there. So just for the time being, it might be interesting rather than sort of thinking that the euro can rip higher. I mean, I think it could definitely test up to, let's say, 105 or 106, but I think anywhere between 105 and 106, these are pretty interesting levels here to be shorting euro against the US dollar. And I think maybe in the case of euro, it might be interesting to look at uh, maybe sort of buying other currencies, maybe buying dips in, let's say, currencies which have escaped the tariffs. For example, we see in Australia at the moment there's no tariffs on Australia, so I just wonder here if the euro has a bit more to fall against Australia, or maybe even kind of curious to look at Euro CAD. I'm not sure if I've got it up here. Let's have a look. Do I have Euro CAD? Yeah, there's EuroCAD here. And you can see here already that's happened, but you can see currencies which somehow are sort of, or countries which are avoiding the tariffs. And while there's still the threat of the euro, could be interesting, any kind of dip. So if we get this sort of going up here or so, that could be kind of an interesting one. It also looks like a quintuple top to be shorting the euro against currencies which seem to have escaped. And talking about a currency like that, interesting to look at the case of the pound. I mean, you can see here, let's say we'll look at the pound just on the futures here, and you can see that the pound has fallen quite a lot against the US dollar. But one thing I just want to bring everyone's attention to is that if we look at the UK economy, first of all, the Prime Minister Starmer has a pretty good relationship with Trump. They seem to be quite friendly. But in terms of the UK exports to the US, it's less than 2% of UK GDP, less than 2%, and with China, it's less than 1%. So the point is that the UK does not really have a trade deficit with the US. They have a good personal relationship, quite strong on defense and everything. So it seems as though the pound and the UK is kind of avoiding the wrath or the anger of Trump at this point. And you've got to say that the other day that Prime Minister Starmer actually was in Brussels, ostensibly for increased defense interrelationship with Europe. But we know that after breakfast, Starmer seems to be putting out the feelers to have a closer political connection with Europe as well. And all of that's going to be positive for the pound. The other thing which could be potentially positive for the pound is the fact that we know with Liz Truss a couple of years ago, there was quite a lot of pain, and we've seen that the borrowing costs for the UK government have gone up quite a lot. But the point is that has actually maybe cleaned out some of the problems in the UK market. In a sense, it's been a little bit of a pain. Whereas, for example, you see in Europe that the ECB is still capping essentially like a soft yield curve cap with, let's say, Italy and let's say Spanish bonds, just to kind of prevent fragmentation. Whereas in the UK, we've seen the bond market, we have seen the yields go up and the borrowing costs go up, and that's imposed a little bit more fiscal discipline on the government. Now, that's going to be short-term painful, but medium-term, there's a case to be made that that's actually not bad for the UK economy, and it's sort of getting its house in order, so to speak. All that to say that it's interesting to look at the pound, and if you look at a couple of cross pairs here, we can see that indeed the euro has fallen against the pound. But I've got to say that any kind of rally up here, 84, 80, 85 and a half, something like that, I think could be a good sell for the euro. Also looking at the pound, potentially against, I don't know, so maybe some other currencies which are a bit more under pressure. But that's one to keep an eye on is the pound. Although just talking about the pound, we do have the BOE this Thursday. There could be a bit of a dovish cut here coming in, so that maybe it's not going to be great for the pound. And of course, we know that the Chancellor of the Exchequer there, the Treasurer, has less fiscal headroom, so less space for stimulus and spending, just because the cost of borrowing, as I mentioned, has gone up. So that's it. Other things to keep a lookout for. As I say, we see that the stocks had a bit of a relief rally yesterday. But relatively short-lived, and until and unless we get complete clarity on the tariff situation, specifically no tariffs, I think it's going to be hard, honestly, for stocks to really rip a lot higher. The second thing to keep in mind is that we had the quarterly refundment part one announcement yesterday afternoon at 3 p.m. No huge surprises there, but really the composition between short-term bills and longer-term coupons, like the 10-year and the 30-year, that's going to be announced tomorrow at 8:30 a.m. if Scott Bessent at the US Treasury decides to issue more long-term bonds, that's going to put the yields up on the long-term bonds. It's going to steepen the curve. That's going to be good for the US dollar, but it's going to be horrible for well, let's say unwelcome by the equity market. Okay, that's going to put pressure on the long-term multiples for valuations, and it's going to tighten financial conditions. US dollar will be stronger, so I expect that would cause a little bit of pressure as well. So we still have to get over that hurdle. On the other hand, if they do nothing and do not signal extra long-term deliverance, who knows? Maybe the equity market can push a little bit higher, but I think we really have to wait until tomorrow morning to get that. Other things to be looking out for. We do have a little bit of data coming in, so it's going to be interesting to see if the market starts paying attention to data and the Fed and everything. Just after this tariff thing, maybe that'll calm down for a little bit. A couple of earnings coming here. PayPal looks like okay. Looks like PayPal's EPS was not bad, a bit higher than expected. Looks like the revenue of Pfizer is a little higher than expected. Okay, so what we do have this morning, we have the JOLTS number at 10 o'clock, the job openings and labor turnover. That has been pretty strong. And again, we want to see the strength of the US employment situation. Also, a pretty important one to keep a lookout here is the quits rate and the quits level. Remember, if people are more comfortable leaving their job, quitting their job voluntarily, that indicates a very strong labor market. If the quits level and the quits level is going down, that means that people are less confident about getting another job, which would signal some kind of tightness or sort of looseness in the market. So let's keep an eye on that. What else do we have today? We have durable goods. That's the final reading for December. So I'm not sure how market moving that's going to be. And then later in the week, things start to pick up again. We've got the ADP tomorrow. Then we've got the ISM services, which is going to be important. Then, of course, we've got the big one on Friday. We've got the non-farm payrolls, but we'll talk about that at a later date. Just to finish off, guys, just want to have a look at a couple of things. Actually, that's why I've got the Bloomberg up here. I showed you yesterday. It's kind of interesting. You see this enormous amount of inventory in gold. So this is the amount of gold, like physical gold held as inventory and storage at the COMEX exchange. So that's the commodities exchange in New York, which is the big futures exchange there. And you can see this incredible run up in volume from about 18 million ounces up to 32 million ounces. I think even yesterday there was another million ounces going in. And this was kind of front running the potential tariffs on precious metals Trump talked about. And you can see here, no surprise that as Trump got into power and started talking about putting tariffs on, you look at this incredible run up in inventories. And of course, that has coincided not only, I don't want to say it's causality or is it coincidence, but the point is that we've seen a very big run up in gold. And let's look at the gold chart. And I just wonder if, the immediate threat of tariffs seems to be dissipating somewhat. Could that take a bit of steam out of the gold market is kind of an interesting one. Let's just look at the futures here. So this is not the spot. You see the futures and you see this huge run up. Now we know the central bank buying. We know that there's a bit of problem nerves about inflation and geopolitics and safe haven and whatnot. But it's interesting to note this big run up in gold and the enormous parallel run up in gold inventories. And I just wonder here, we might start seeing gold stalling out a little bit. In fact, I might put on I've got a set of indicators here. Let's have a look. So the momentum is still trending upwards, but these yellow ones on this particular set of metrics here, they indicate the potential for a reversal and a stall out. You see these two yellow ones on this particular signal here. And so let me just get rid of, I've got some DeMark setups here as well. So that's interesting. We're also at the very top of the Bollinger Bands. You see on gold here, we're at the top of the daily Bollinger Bands. Let's have a quick look at the weekly Bollinger Bands and just have a look there. No, so actually we're well outside the weekly Bollinger Bands. And actually, if you see on the weekly, I mean, it's only Tuesday, but we're starting to form a little bit of a doji here on the Japanese candles. So if we just go back to the dailies here, you can see that in terms of the MACD as well, pretty strong momentum there. So very strong momentum, but maybe just stalling out a little bit. We're starting to see the stochastics here, which is measured with RSI and other stochastics here, starting to roll over and flatten out. And when we get two or three of these red ones here, it starts to indicate a potential for reversal. So, according to all of this, interesting. I think gold's one to be looking out for. Maybe a little less tension in the world because of the tariffs. That could be interesting to take a shot. I don't love the idea of shorting gold because there's many reasons to be long gold. But I think at this point, it looks as though this rally could be running out of steam. So either potentially a short, but possibly more a buy and dip. Let that sort of ease off a little bit. Let's just have a quick look as well, just while we're here on copper. Copper had a little bit of a bounce, just in the idea of less. I don't know, less aggressive tariffs, but the reality is we now have tariffs on China. So I think copper here is in the middle of the range. I'll leave it there today, guys. I'll talk a bit more about bonds tomorrow. Bonds, just quickly, just to finish off, bonds had been trading as though the tariffs were sort of mainly inflationary, not so much a hit to growth. So remember what we're trying to figure out here is that is these sort of tariffs or the threat of tariffs, and now it seems more like a threat of tariffs, are they just purely inflationary or will they actually cause a slowdown and it's more to be seen as a threat to growth kind of situation? So that's what we have to try and figure out is it, inflation going higher or as a threat to growth. And what we have seen is that so far the bond market has really taken that with a bit of weakness at the front end of the curve, which would indicate, less Fed cuts and more of a sort of inflation worry. So it's going to be interesting today to see if there's any kind of rally going on in the short term, the short end of the curve. Let me just clean this up. Sorry, I just want to take these guys off. Let's clean this up. White page. Yeah, if we look at the front end of the curve, which I will look at here. No, still not too much of a bounce. So, still under a little bit of pressure. Let's have a look out, let's say at the ZB, still under a little bit of pressure here. So the bond market's still under a little bit of pressure. And not particularly getting too much of a relief rally today. So let's look at the JOLTS numbers, see how we go. I'll leave it there. Things getting a little bit late. Have a great day. We'll no doubt still be in touch. Thank you.